From a first principles perspective, why does it make sense for anyone, an individual, a company, a sovereign, to actually borrow fiat to go buy Bitcoin? Under what conditions does that strategy actually make sense, and what do the debt terms need to look like?
Fundamentally, it's an arbitrage against appreciation of the dollar and the nominal interest rate that you're able to get on it versus the appreciation of Bitcoin. Because let's say you have your dollar, or I'm just going to use dollar as a substitute for fiat because I don't like saying fiat. But so let's say you've got treasuries that are paying 5% per year, ostensibly, but also potentially having negative real yields if inflation's higher than that. But then you've got Bitcoin, which is had a historical CAGR of anywhere in 50 to 60%. Some years much higher than that. Probably will trend slightly lower over time as it matures. But if on the one hand you've got an asset that has an annual return of say 30 to 50% versus cash where you can get 5% nominal yield maybe, then just by borrowing money and putting that in Bitcoin, you've got a spread of 25, 45% that you can earn per year.
Do you think there are any different considerations that an individual company or sovereign might take when deciding to actually buy Bitcoin?
Yeah, the other thing that anyone has to watch out for if they're borrowing to buy Bitcoin, if they're taking leverage to buy Bitcoin, is volatility, right? When you buy a house and you put down 20% down payment and you owe 80%, that's like a 500% leverage ratio. If you're that levered on Bitcoin, tiny move can wreck you. But a company like Strategy, they're targeting a 20 to 30% leverage ratio. They can stomach potentially 80 to 70% drawdown in Bitcoin and still come out the other side as long as Bitcoin comes back. So that leverage ratio is one thing you really have to pay attention to. It's just how levered you are. Another thing is, how are you going to get access to this debt? If you're just an individual, are you going to use a credit card that has a 20% APR on it? That might not really be the best way to borrow. Are you going to use a home equity loan with, say, 7%? That's a little better. A lot of people a few years ago basically took all the equity out of their homes at 3%. People who did that and parked their equity, parked the cash they took out of their home equity into Bitcoin are very happy now. Now, I personally would not recommend mortgaging your house and buying Bitcoin. I think it's a very risky thing to do. But if you're a corporation, you've got very different avenues available to you. Strategy goes out and issues a convertible bond. They can borrow at 0%, and they can print new shares to pay it back. They don't even have to make any cash. They can just print new shares. And as long as they're able to issue these shares at a premium to the Bitcoin value that it represents, to the underlying Bitcoin value of these shares, they come out ahead. So let's say on a per share basis, there's 50 cents at Bitcoin. If you divide the Bitcoin value of the company divided by shares, let's say that's 50 cents per share. If they're able to go out into the market and issue a convertible bond and effectively get, let's say, $3 per share or $2 per share, then you're able to buy $2 worth of Bitcoin for 50 cents worth of exposure, and you're able to capture the spread of, say, $1.50. That's a very good deal. If I could do that, I would do that all day long, or at least up until I was 20% levered.
Yeah, it makes sense. And finally, for this section, how did Bitcoin or learning about Bitcoin change the way you approach investing in general as part of your own journey?
Sure. I think probably the biggest fundamental change is that Bitcoin became my new hurdle rate. I think pretty much anyone who's picked up a personal finance book in the past 20 to 25 years has read the same strategy. They've read things like, most traders can't beat the market. Most assets don't beat the market. The safest thing for most people to do is just DCA into the S&P 500 index over a lifetime. And that's one way to do it. But I think that way of thinking is eventually going to get replaced by people just saving in Bitcoin. Because a lot of what people do for investing is not really investing. It's an attempt at saving. They don't really have a good way to save. Their money is depreciating. It's a melting ice cube. They've got to stick it somewhere. They don't know what to do with it. They're not professional money managers. So they stick it in the S&P 500 index because that's what the personal finance book said to do. And I think that could change over time, where we see people just saving in Bitcoin. And they don't have to worry about the risks that come with owning a portfolio of equities that they know nothing about. So yeah, that's the first big thing, is that For me, it's the new hurdle rate. I think it's going to be the new benchmark that eventually replaces the S&P 500. And also, when looking at these Bitcoin treasury companies, I think it gives a metric to measure against that people didn't really have before, right? If I'm going to buy a strategy, my benchmark is Bitcoin, and it's very easy to compare. Did it outperform Bitcoin or not? And it's not really something that people are used to looking at with, say, like NVIDIA. If you're going to buy NVIDIA, what's the Bitcoin-like comparison there? Is it like an index of AI companies? Is it? There's no real straightforward comparison. You can kind of compare it to the S&P 500. You compare it to market indices, but it's not quite the same clear comparison. So I think that's very interesting. We've got a very clear benchmark to measure all other investments against.
Yeah, perhaps if more and more people start to look at Bitcoin as the hurdle rate or the benchmark, then that might be one of the catalysts that pushes more of these companies, particularly the big tech companies, to maybe have to acquire some Bitcoin to put on their balance sheet, right? So that they remain competitive from a stock appreciation or stock performance standpoint.
Right. Well, the other thing that we're going to have to think about is, let's say on the one hand, you can invest in an asset with a 30% CAGR, or you can invest in a new line of business. If that new line of business, if the expected, let's say the expected return on that is 15% per year, you're better off not doing that and just putting the investment into Bitcoin from a pure returns perspective. There might be other reasons why you want to build up this new line of business, but it provides a new hurdle rate, not just for capital investments, but also for business investments. Do I want to go out and start my own business? Do I want to buy, let's say, real estate and have all the hassle that comes with that, or do I just want to park my money in Bitcoin?
That makes sense for sure. Yeah, we'd hope that'd be the case with financial assets to really give people options, flexibility to do what makes sense for them and their family and their futures. Wanted to move on here a bit and focus on providing a bit more alpha for our listeners. We talked a little bit about some of the strategies, new KPIs. I think you mentioned BTC Torque, which they recently introduced. Over the past year, Strategy has introduced several new business KPIs. Initially, BTC per share and BTC gain, as well as several other new ones on their most recent earnings call. Are there any new ones from the earnings call that really stuck out to you? And which KPIs do you think are most useful for evaluating the business and explaining its performance?
Well, if you're going to invest in a Bitcoin treasury company, I think one equation that everyone should be familiar with is Bitcoin per share times MNAV. Because that really is the benchmark for whether or not you outperform Bitcoin or not. If Bitcoin per share times MNAV is higher when you bought it, or the other way around, is higher when you sell it than when you bought it, then you outperform Bitcoin. If it's not, then you didn't. It's very simple. So one, be familiar with that. In terms of the new metrics that were introduced, I think the two that are really going to be good to pay attention to are BTC Torque and the BTC credit rating. BTC Torque is important because it really highlights how creative the different instruments are under different market conditions. And they've got these really beautiful charts that show that basically Strife is basically the apex predator of all the instruments they have right now. And depending on your assumptions about MNAV and Bitcoin CAGR, the other instruments actually vary quite a bit in how accretive they are in comparison. So I think that is something that would be good for people to really wrap their brains around and to think about as they look at how market conditions change over time, which one of these instruments are going to be good to issue. And if you're really trying to forecast what MicroStrategy is going to do, to really think about, okay, we're in a high volatility scenario. Maybe they're going to issue some convertible bonds. Okay, we're having an MNAV blow off top here. Maybe this is a situation where we're going to see a lot of ATM to capture some of that premium into permanent capital that they can use as a base to leverage up against later. So I think BTC Torque and just thinking about those market conditions is going to be really important. The second one that they spent a lot of time talking about was BTC credit rating. And I think that is going to be less important for, let's say, the retail investor to think about. It's something that's going to be more important on the back end for them when they're trying to issue their fixed income securities. Because right now, one of the things that's different about Strategy is they are heavily over-collateralized. when you have a 20% leverage ratio, that means you've got, let's say, 4-to-1 ratio of assets to liabilities. It's a very different scenario than if you are, say, buying real estate and you're leveraged the other way, where you've got 20% down, you've got an 80% leverage ratio. It's a very different scenario. And so when you think about the credit worthiness of companies in these different situations, strategy ought to be getting more credit for having this heavily over-collateralized position than they are. They should be getting smaller credit spreads than they have. And what they would really like to do is go out and talk to these credit rating agencies, talk to the companies that they're issuing these fixed instruments to, and to really have them take that more into consideration and say, hey, this is actually very low risk debt. You should be wanting to take a lot more of this and at a much smaller spread. And they've got some selling work to do that. They've got some marketing and sales work to do to really, I think, communicate that and to convince the market that's true. I think it's true. I think they're right about it. And if they're successful with that, that is really what is going to fuel the next leg up for them. If they really want to capture 1% of the $300 trillion fixed income market, get to a point where they're raising $3 trillion, that is really, I think, where they need to put their time and effort. They see that. It makes sense to me. And I think that is exactly what they should be doing and where they're going.
No, wonderful, wonderful. Really good points on that. I think it's really interesting, especially around the BTC credit, right? So, as you mentioned, their leverage ratio, the ratio there is like 4-to-1, their assets relative to the debt. If you think about a lot of private equity companies that are in, this traditional finance space, when they go out and do acquisitions or do projects or investments, there's a lot more leveraged use there, right? But I think it's, we still have a lot of people in traditional finance when they look at something like a MicroStrategy or hear even the name Bitcoin or the word Bitcoin, that kind of scares them away. They think there's way too much debt there. They don't really understand how strategy is managing this. So I still think there's a lot of education that needs to be done there, and also therefore a lot of opportunity once the market starts to understand and digest this and actually give strategy credit for what they've been able to build here and how they're managing their risk and their debt.